Tonight we'll be discussing price patterns and especially Gartley. We'll explain why and how price patterns work, where do we need to enter, where to look for price patterns, where to look for Gartleys, where to place entries, stops, limits. Anytime during this presentation, if you guys have any questions, please feel free to type your questions in the chat box, and I'll make sure to answer all the questions. First, I will start by drawing a Gartley outside of the charts, and then we'll look at some examples on actual charts. I will explain some rules, where to look for Gartleys, and what Gartleys actually are. Gartleys are continuation patterns. By continuation, I mean that we trade Gartleys with the direction of the trend. So if the market is making higher lows and higher highs, that means that we'll be looking for bullish Gartleys in an uptrend. Now, as price moves higher and higher, a lot of times we'll see some sub-swings that with those sub-swings price will retrace, and those sub-swings would form different price patterns. One of those price patterns is called Gartley. In a few minutes, I'll explain a little more about those Gartleys. I just want to talk a little bit about price patterns and what are they meant for. Basically, price patterns are designed to find areas where buyers and sellers would be doing the same thing at the same price level, meaning that buyers will be buying and so will sellers, or buyers will be selling and so will be the sellers, meaning that both teams, the bears and the bulls, will be doing the same at the same price. And probably most of you right now think that how is this possible? How can buyers, bulls, and sellers, bears, can be possibly buying or selling at the same level? This is an interesting question, and I will explain how this is possible. Let's say we're a buyer, or our analysis tells us that based on previous moves, I'll just give an example here. Let's say based on those previous highs, we form past resistance becoming support level. And once we pull the fibs, I want to make it just perfect so you guys can understand. Now, I personally, if I see this setup, those previous highs that provide us with support in future, and when we pull our fib, let's say we have our swing AB. Now, if I want to be getting long, most likely I will be looking for an entry somewhere here around the 786, because this 786 first is a fib level, and second, it's converging with this previous resistance now becoming support, and this now becomes my buy level. I know that based on my analysis, I want to be buying 1926. Now let's take a look. Now my entry order in this case as a buyer I will be buying at 1926. Now let's think as a bear. A smaller intraday trader, let's say, shorted the market here. He has a small subswing, a small A. Here we'll place the B. Then we have C. The seller sells the C, and one of his targets most likely will be 127. The first extension is probably one of his targets. One of the next targets might be the 1618, lower, but probably one of the first will be either the B at 1929 or here the C, the 127, I'm sorry. Now note how this 127 is converging with the 786 that we as buyers want to enter. Now if a seller sells the C, what would be the D as an order? If this is his limit, since he is selling, his limit order will be a buy order. So the seller will be buying also at 119.27. So we have both groups of traders, the sellers and the buyers, executing same orders. The seller will be buying at this level, the buyer will be buying at that same level, and this gives us very high probability that since both the bears and the bulls want to be buying this pair at this price, now we have very, very high probability that price will move north or bullish. Now let's see how this would look on a chart. Then I'll give some rules of how we're supposed to be entering, where to place entry orders, limit orders, stop orders, so it becomes more clear for all of you guys. I will go to recent charts. Now this is USD JPY, and we're looking at 1 hour chart. And what we have is one main swing, bullish, and I'll call this swing XA as our main swing. And then we have a sub-swing, which is the pullback, and this is our ABCD swing. Now note on this swing how the 127 is converging with the 786, this is what we talked about, of the main swing. Now here this becomes our entry level. This is where we want to buy, because we know that buyers, bulls, want to enter at this 786 level, and we know that bears want to limit out at 127. Now, when we trade price patterns, we want to have few different limits. Now, most of the time, for 15-minute or 1 hour time frames, I would enter anywhere between 2 and 3 different positions. Now the entry is the convergence between the two fib levels, the 786 and the 127. Since we're buying, we want to place the buy order a little higher than the convergence, because we want to cover the spread. So let's say if the convergence is 91.03 and we have about 3 pips spread, I would place an order at 91.06, maybe 91.08 for a buy. And where does my stop go? Now this here is the entry. So I'll just make a note. Just give me 1 second. There is a few people who have their settings for the audio to use telephone, and I can see them, and they still can't hear us. I'm trying to explain those guys that they need to move their settings from telephone to use mic and speakers. Now, this is the buy entry, and the stop is supposed to go here below the X. So if the X is 90.53, we're supposed to place the stop somewhere at 90.40, 90.45, about 10 pips below the X. Now, so the stop goes below the X. The buy entry is just above the convergence, so we can cover the spread. Now the next thing we need to take care of is the limits. And now when I start talking about the orders, I said that we must place a few different limits. So we will have multiple positions. In this particular trade here, I would use 3 limits. Now, why do we need different limits, multiple positions? Why don't we just place one at the top with all the entire amount of money that we can put on the trade and just wait for the market to go all the way up there? First, we're not sure if price will go all the way to the last place where we believe price will go. We want to make sure that we'll take profit on a way up. Now the first place where I would place a stop, now note how I move the subswing. Now I will start thinking as a bear, as a seller. I want to find out if I would sell, where would I enter? Where most likely is the place for me to enter the market? And if I'm thinking as a bear, this swing, now the AD becomes my main swing. Here I would find past resistance, past support becoming resistance, converging very close with the 618 of my Fibs. And this is where most likely I would place an entry if I want to sell. So if I'm a seller, probably I'll be selling here somewhere at 92.15, 92.10, maybe 92.05. Let's see where this low is. The low is at 92.04. So anywhere between 92.04, 92.10, 92.10 would be my entry sell. Now we want to limit before those bears enter the market. Now we want to enter below this level of resistance that is being formed around 92.05, 92.15 level. So most likely I will place my first limit at 92.00, or maybe just a little below the round number, because round numbers like 92.00, 93.00 can act as very strong resistance. So my first limit would be 91.98. If I want to push it, would be 92.00, because I want to be below this support becoming resistance area that is right next to the pivot to the 618. This way, if at this level more bears enter the market than bulls bought here, we will take profit and we won't lose on the trade even if the market continues to move bearish. The idea of this is that if our analysis is wrong and the market is going to continue to move bearish, we're going to take profit before the sellers enter the market. And when, now this is the first rule for the limits that you guys need to just make sure that you always do. As soon as your target 1 is filled, so you take profit at your target 1, you move your stop from all the way down here to break even at your entry. So from what was 90.43, we move our stop to, let's see where the entry was. We said that we're entering 91.08, so from 90.43 we moved the stop to 91.08. We took profit at 91.98, so the first limit brought us 98 pips. Now we have the stop at break even, and we have 2 more positions to go, 2 more limits. Now see how we eliminate the emotions. Now if we trade only one position, and let's say the market rallies all the way here to support, but you know that price might go all the way up here. Now imagine what happens. Price might go all the way up. Here you'll be almost at 200 pips on your balance on the trade. Then price can go all the way down, maybe even retest the entry, and then go up. It might never go up. It might actually continue on moving south. And when we see price move up and down all the time, it's most likely that we will close the trade or we'll be in too much pain and a lot of emotions. Now, when we use multiple targets, we take profit, and this is not a bad profit, 98 pips. We take the first profit, we place the rest at break even, and now we can care less if the price will go all the way up to the last one or not, because we already cashed profit. Now price can go even against us, we're still making money on the trade. And we are absolutely emotion free for the next 2 positions. Now, where do we place the second position? Target 2, I would usually place just below the resistance or just below A. Now the A right now is the strongest resistance that we have because this is the current highest high that we have. So this is the strongest resistance possible. So I'll draw a line over the bodies of those candles, and I want to limit before that level. I don't want to place my limit right next to the resistance. I want to make sure the price can easily get there. So I will place my second limit below the resistance. When price moves, you have two choices. The one is to leave your stop for the third one still at break even, or you can move your stop to target 1. So let's say price moves up. Now here we have resistance becoming support. Price can come back to retest this resistance becoming support. Note that target 1 was below this level. So even now the stop is in safe place. Here price might bounce off this level and continue to trade bullish to hit the third target. And where is this third target? Now, third target is usually based on where and how big this AD was. Now, if the AD gave us convergence here at the 786, I would go to place my third target below the 127 level, the 127 extension. Now the 127 is at 93.50, so I'll place my third target at 93.39, 93.40. If the convergence was, let's say, 618 with 618, or the entry was somewhere here, and the low was at this price and not at the 786, then we can go for the third target all the way up to the 1618, because this shows us that the bullish move might be a lot stronger. So again, we enter at the convergence and we add a few pips for the spread, so the entry is just above this convergence level. We place the stop initially below the X, and when price starts moving, once it hits target 1, we move the stop from the original price to the break-even level. The break-even level is the price we entered. Once target 2 is filled, we can move the stop to target 1. Once target 3 is filled, we can move the stop to target 2 if we have more than 3 positions, if we have 4 or 5 positions. Now, when would I have more positions? Let's say that this Gartley is converging with pattern from higher time frame. If I have a bigger pattern that allows me to place limits somewhere higher, then I can place more lots into the trade and have more positions, more limits. But I would never place just one all the way up there and wait for weeks, days or weeks to have this position filled. Our job is to make pips and to profit when the market even makes small moves. And here, even if now price does not go all the way up where we expect, but continues to trade bearish, let's say price does something like this and continues the bearish move, well, we're still in profit because the stop now is a break-even point, and we're up 98 pips out of the trade. Do you guys have any questions so far? I want to make sure if anyone wants to ask. In the meantime, I will continue with some of the different convergences that we can get on a Gartley setup. Now the risk reward. This is a good question, and usually I have a full class just based on the risk reward, because I look at the risk reward a little more advanced, and I want to explain to traders why risk reward is so important. A lot of new traders, especially new traders, don't realize how important the risk reward is. But by trading, and especially when trading patterns, even with any other strategy, not just price patterns, we need to make sure that we have good risk reward. A lot of people trade with one-to-one risk reward. I personally don't agree with trading one-to-one because our success ratio, in order for us to be profitable, need to be very high, anywhere between 80 and 90% if we're trading one-to-one risk reward. And even if we're doing 80 to 90% on a scalping strategy with risk reward one-to-one, it's most likely that account will be losing on a longer term based on the spread. So I have full class just based on risk reward. I try to do target one to be at least 1 to 1.5 risk reward, just to answer the question. Sometimes 1 to 1.3, but I want target one to be more than what we risk. If I risk 50 pips, I want to be gaining on target one at least 70, 75 pips. Let me read other questions. Scott is saying that markets lately have been unpredictable, and if there is anything to predict if the pattern will work out, or we should invalidate it. Yes, lately markets have been very unpredictable, and what we can do to confirm the price pattern is sometimes we can use candlestick formations. Candlestick formations like hammer, hanging man, evening star, tweezer bottoms, tweezer tops, engulfing, bullish or bearish candle. Any of those candles we can use, like when they develop at the entry point, we can use those for additional confirmation. Also, we can use, let's say, pivot points converging with the entry for additional confirmation. But the best thing for us to do is with those markets when they're so fast, is just try to trade with the trend. Don't look for reversal patterns unless they will reverse. I mean, like if you're looking for reversal pattern on a small time frame to reverse towards the general trend, meaning that, let's say, we all know euro dollar is in a very bearish trend in general, but let's say here we see this pullback and we have this support becoming resistance area, and we go to 15-minute time frame, and at this support becoming resistance area we find, let's say, bearish butterfly, which is reversal pattern, or head and shoulders, also reversal pattern. In this case I would trade reversal pattern because this pattern will reverse us to go in the general trend. But here, if I see bullish head and shoulders on 1 hour time frame, even a 1 hour time frame, I have absolutely no reason to believe that price will move because we're in such a strong bearish trend. I don't have a reason to believe price will go bullish. But if that head and shoulders, let's say, formed here, this is something different. Because on a 1 hour time frame, those 3 days of trading will look like very steep uptrend, and we will be reversing that uptrend. Basically, trade with the general trend. Don't try to put an end to a strong trend. Like butterflies, crab, head and shoulders, all those are reversal patterns and are supposed to be traded at level where we believe that price will be reversing. Now I use the bigger time frame. The question, if I read it, did you see the big time frame before the trade in your regular time frame? I hope I understand the question correct. When I'm trading, I look at the general trend. I use 4 hour or daily time frame to find the direction, and I trade based on this direction. And if the daily time frame or the 4 hour time frame tells me you're in an uptrend, when I go to 1 hour time frame and I find bullish Gartley, and the bullish Gartley is continuation pattern, meaning that needs to be traded in a bullish trend, then I would trade that pattern, because the daily time frame told me that you need to be trading bullish. Now, if the daily time frame tells me, okay, we're in a bearish trend, and I will be looking for bearish patterns on smaller time frames. I hope this answers the question. Basically, what we can also do is, even here, let's take a look at this 4-hour chart, just to give you guys an example of what I'm talking about. This is pound dollar 4-hour chart. This happened last Thursday or Friday. Now I have my main swing, XA, the X is here, probably is hiding somewhere. And then I have subswing, past support becoming resistance level, converging with the 618 downtrend line, passing by very close. Then I have 127 extension, converging relatively close with the 618. For the 4-hour time frame, 15 pips, even less, is not so bad for convergence. Now I know that here around this area we need to be looking for bearish opportunities, because this is where the pullback, because this is a pullback, we're generally in a downtrend on pound hour, the pullback might be ending. So what we do is we go to a smaller time frame, and here is this. I will circle the high. This high is here, this high. Now, what do we see? We see a couple of things. First, we used to be making higher lows and higher highs. Let me delete this line. Now we start making lower lows. This gives me right away the idea that price is reversing, and we expect the reversal at this level based on the 4-hour chart. So now I'm looking for reversal pattern. I'm looking for head and shoulders. This could be my left shoulder, and I'm looking for N3 at pretty much the same price level, because we took the low, we broke the previous low. Now price will come back to retest this left shoulder to form the right shoulder. Now another thing that we can find in this setup is, since we're starting the bearish trend, I pull my fibs and make sure the fib is correct. Yes. But I believe was on a smaller time frame, not here. We have 86 with 1618 convergence. Now usually I'm entering a few pips below the convergence. I believe last week's entry was 47.42. Let me check. sell 47.40 was the call for last week. So 47.40 was the sell entry. Here's how it looks on the website. We have sell at 147.40 with a stop 147.84, target 1 and target 2. And here is the chart when the trade was called. The high came to 47.42. So here we have bearish head and shoulders and also a bearish bat, because this, the 86 with 1618 convergence, this is a pattern called bat. And this is what we were trading. And now we have all those different strategies telling us that we need to sell this level. First, we have the 4-hour telling us, okay, we're close to the trend line, resistance, support becoming resistance, two convergences, 618 with 127, very, very strong resistance area. Then the 1-hour chart is giving us bearish head and shoulders, bearish bat, very close to each other. Oh, this cannot be a losing trade. And this is how analysis is supposed to be done. We need to look at higher time frames, then we enter on a smaller time frame based on what the higher time frame told us. The higher time frame told us that here price might be reversing. The smaller time frame confirmed with two patterns, not one but two patterns. And even if you want to confirm the reversal one more time, you can use this bearish engulfing candle to enter and place your stop like 10 to 15 pips above the candle. This is also good way to enter. To answer the question to Scott, who was asking if we confirm the entry. Now, way to invalidate the pattern. Now, if we see large, huge candles, like candle like this, look at this candle. I'm trying to grab the circle. Look at this big candle here. If we have a candle like this going against us, like let's say I wanted to short the market somewhere here and I see a big candle going against me, where I wouldn't want to enter at this level because we see very large volatility going against us. Of course, this can be this candle can form a wick, but it will be a lot safer even if the candle pulls back. Most likely, the next candle that forms will be some kind of bearish candlestick formation that will confirm the entry. So if you see big long bars going against you prior to the entry, just pass on the trade or wait for the market to calm down and maybe give you bearish candlestick formation. Another reason for you to invalidate a trade might be a news announcement. Let's say NFP is coming out or retail sales are coming out. Well, we're right next to an entry. Well, most likely I will cancel that trade because I don't know if this news announcement will push the market in my direction or against me. Now, there is some techniques to use fundamentals with price patterns. Those are a little more advanced, and we'll talk about those in other classes. But there is techniques to use by trading patterns with news together. If you guys don't have any further questions, I want to thank everybody for attending today's presentation. I hope this class was helpful for everyone. And I hope I see all of you guys next Monday. We do those classes every Monday. Thank you, everyone. Thank you guys for attending. And I wish you all safe trading.